Hi, this is Randy Finney with the Right Side of the Chart, and this is a closing market wrap for Tuesday, June 11th, 2019. We'll mix things up a little bit here, look at a few different charts. And before I get into the charts, just wanted to talk real quick on the fundamentals and what's going on, at least my interpretation of what I see out there. The market recently has rallied, and again, it was all, the rally itself was priced in to the charts. Very oversold, at support, bullish divergences, et cetera, et cetera, et cetera. So the rubber band snapped back, and it snapped back hard like it usually does during after a sharp downtrend. But what's going on now in the recent days, as I said, the news will often follow the charts. The markets reversed. They broke out of those 60-minute bullish falling wedge patterns on SPY, and then QQQ took out the downtrend lines. And then shortly after, the news started getting much better than it was leading into last Monday's lows. And one of the things here that's driving the market lately is it's rallying on bad news. Now that's nothing new. It's done that before. But where some people might get confused is bad news right now is good news for the market because this market is addicted to low interest rates like crack. It's the stock market's crack or whatever the drug du jour is. I grew up in the 80s, so what do they do now? Crystal meth, anything else, so you pick your poison. But that's what the market is rallying on in large part. Mexico tariffs, that was a farce. I had no doubt that would be resolved. China's a much bigger deal. I think most people have little doubt, and look at the agreement. There's nothing getting done there. Nothing's going to change. But anyways, let's get off that real quick. That's fundamentals. So really what I'm seeing and reading is as the cause where the euphoria is coming in is the fact that there's been a very sharp increase in rate the next an upcoming rate cut, whether we get it next week at next week's meeting or not, or the following meeting. All right, so here's what I wanted to say to that. Typically, yes, rate cuts are bullish. However, historically, they are not always bullish. In fact, there's some statistics I want to cite. Got to pull that up. Let me see if I can find that real quick. Okay, here it is. I knew I had it somewhere. All right, this is back in 2007. This was in a trading forum, and what I posted at the time is just virtually nobody thought that the bull market was over, and B, that we were looking at one of the biggest bear markets coming up in history. And again, that was market top back in October '07. So, anyways, one of the things that I had posted there is this factoid. I got it from the Wall Street Journal. In an unscheduled meeting on January 3rd, 2001, the Fed cut rates by 50 basis points, which is 0.5%. NASDAQ had its best day ever, rising 14.2%. The NASDAQ fell 57% after that first cut in 2001. In fact, investors would have done better if they held off buying tech stocks or otherwise until the Fed started raising rates in 2004. So the point that I'm trying to make is there's a couple things about rates. Yes, lower rates certainly are bullish for the economy and bullish for the stock market. However, history shows us that a pause in a rate increase cycle, which we had back in December when the Fed pulled a 180 and they decided to stop hiking. Remember, they had already started to do a few hikes. But history shows that once you've turned that corner from a rate hike cycle down to the first cut, historically from there the market drops. That's the first in usually many cuts. So I just wanted to state that any cut now that may be coming next week or at the next meeting or anytime this year, statistically speaking, that's bearish. Remember, we were on a declining rate cycle, but so we had a pause back in December. So take it for what it's worth. And also, more importantly, right now we're really seeing what I believe to be a pretty rapid rollover in the fundamentals. I don't have time to go through. There are many different fundamental indicators, but the three pillars. I did a video back a month or two ago, and more on fundamentals. I focused primarily, if not exclusively, on fundamental analysis instead of this stuff. This is technical analysis, and we're going to get to this charts in a second. But there's three pillars that I'm looking at. Three pillars that will absolutely make or break the economy, the bull market, the stock market, and those are there three markets itself: the stock market, of course, itself, the real estate market, meaning the housing market, and the job market. the job market, and it all ties in. All three have to do with the consumer, because consumer spending accounts for about 2/3 of GDP, gross domestic product. That's what's driving the economy. When the consumer buckles, everything else goes. That's facts. That's not even debatable. So right now we're at the job market's strongest, at uber low levels, record low levels. But again, it's at levels last seen back at prior bottoms in the employment cycle. So in other words, unemployment can only start going up from here. The job market, for with a little exception, there's always a little more downside when you hit a floor. It's not a hard floor. There's no 0% unemployment ever. But for the most part, it can only go up. Now, it can stay low for another year, 2 years. There's no law that says it must go up. But when you look at past cycles, and I didn't really pull up the fundamentals for this video. I don't want to do that. You have to trust me on this one, or just Google, do a quick Google search for employment history, employment chart. You'll get a chart. And then the other, of course, is the housing market. So the job market, number one, you lose your job. That's probably the most important. When you see that start to go up, and we're starting to see some turns there, but you get the zigs and zags along the way. You can't say, oh, the bottom's in when you start to turn. But I want to say there's some cracks forming there. The other is the housing market. I did an extensive video on that. I'll probably do an update soon showing you major metropolitan areas, around the country that we're seeing. It's very, to me, we're in that phase where we were about 2006, even though the housing crisis really, in the correction or the bear market started in October 2007. What happened with the housing market is prices went up. They didn't drop right away. They just froze. Nothing was moving. And the number of houses coming online for sale was increasing. So I'm seeing some trends there that are concerning in the housing market. And why is that important? Again, the three components that make you, me, most of us feel good, confident, and spend money are our house. If you own a house, the value of your home, that goes up. On paper, you're gaining wealth. Obviously, job market, that's a given. And then, of course, the stock market. And so they're all intertwined, and any one of those three can buckle, and then it have a domino effect on the rest. So right now the stock market's not far off all-time highs, so you can't really knock that one yet. And the job market, of course, is near all-time lows. Real estate market's actually up there, but those are the things I'm looking for. And I just wanted to say again, we're starting to see some concerning the economic indicators rolling over, and that's dangerous. That's why there's this talk now, whereas just a few months ago, heading into the end of the year, it was not a matter of what will the next move from the Fed be, a hike or a cut. It was a hike. They had a dot plot that they had planned several more hikes, and so they pulled a 180 after the market threw its hissy fit back in the fourth quarter. You all remember that, and I predicted it would happen before it happened, that we would drop. A, the market would drop, and B, when it dropped, the talks will turn from, the Fed hiking. They'll move over to a dovish stance, and that's exactly what happened. That was the catalyst for this rally here. The crack addict or the meth addict is going to get more of its medicine. So all I'm doing now is kind of doing this on a smaller scale and pointing out that fact that I think the rally is misplaced at this point in time, because at some point lower rates stop working. It's not you can't keep the market rising forever, and so I'm more concerned. I think that will start to manifest itself in selling soon from institutions, especially big pension plans, 401ks, or professional money managers, pension plans, hedge funds that see the economy rolling over. And it doesn't matter if you're giving money away, at 0%. Once the ship turns, it's a vicious cycle. There's a domino effect there. So those are my fundamental thoughts. Now let's just dive into the charts and see where we're at today and what happened this week. All right, today we had some interesting developments. This is the Dow. I said we do a few things different here. I'll talk on the Dow. You can see is pretty much triple topped here. Let me try to grab a circle tool, and I just showed 1, 2, 3. There's a triple top on the Dow. When we're closer to that high now than low. And really, when you look at a triple top pattern, you'd have to zoom out. This is only a daily chart going back 2 years. But But the way in technical analysis, you take the bottom of the pattern. This we overshot quickly and snap back up. So I'm using this as the base of the triple top pattern. And the way you measure out or try to trade these is the sell signal comes on a break. If you have a triple top, a break below the bottom of the pattern. Now that's quite a ways down. That would be a pretty big drop. And then at that point, if you do drop below, the measured target is the distance, the width of the pattern, for the distance from top to bottom. That would give you your measured target, which might look something like this. So just kind of an FYI. Now, triple tops don't mean because you put in 3 tops you can't break above there. It's just resistance right now. So if we keep going up here and we pop above new highs, then yes, that's bullish, especially if the breakout sticks. And as I often say, doesn't do it with divergence. If it does it with divergence, like we've already done in QQQ and some other things here, remember the Dow has yet to take out a lot of indexes topped in 2018. And that's why here's the Dow. And the S&P to put in a roughly equal double top. So I'm going off the premise, whether you want to, semantics, call it what you want, that this is, that we may still be we could be in a bear market that started back here in 2018. And that would be the case if the Dow never takes out that high, again, technically speaking. But you're really, splitting hairs. If you get within a few basis points, you can call this the top if you want. You can call that the top if you want. It's all around the same level when you really zoom out and look at the bigger picture. You're talking just mere percentage points. So, all right, so where am I going with this? Like I said, breakout to new highs, certainly possible if we continue to rally from here. And in doing so, it'll be a divergent high. So it's not really a breakout to a high that I would chase, because much, much more often than not, my experience, breakouts that occur, A, with negative divergence, and B, while overbought, because that's what would happen if we continue up over the next few weeks here. Now, if we consolidate for a long time, maybe change things around here, we're not overbought anymore, and then we go on to breakout, that might be a different story. But as of now, any breakout anytime soon would still run an increased risk of failing, just like this marginal new breakout to an all-time high had some divergence, overbought, and again, like in the other indexes. So that's that, and we're not even there yet. In fact, we're still comfortably above the all-time highs there on the Dow. And I wanted to point out, here's what I wanted to show you today. We had some bearish engulfing candlesticks. Now these things you got to watch out for. What a bearish engulfing candlestick is, when the body, the fat part of a candle, completely engulfs the previous day's candle, the body of it, I should say. You don't worry about the skinny part. And this was a little mini crash, fat fingered trade in Dow today. That long wick doesn't really mean much there, the tail. But the body is certainly significant. And there is a bearish engulfing. You don't want to look for these and read too much into them if they just come in the middle of a trend. Sometimes you'll get them. Where you want to look for a bearish engulfing candle is after a prolonged uptrend. Here was a bearish engulfing. That was it. That marked the high of the rally back there in, what was that, early May. And then boom, you can see what happened after that. There was a bearish engulfing, came right there, right after the top of an uptrend. That marked a pullback, and it was a correction. We didn't drop too much, but again, there were a lot more technicals lining up here, so you get the trend line break. So that's why, if they're just kind of random in the middle of nowhere and I don't have any other sell signals, I'll ignore them. I'm not going to really trade off a bearish engulfing that comes without any other type of confirmation, like a breakdown of a trend line, a bearish technical pattern, anything else like that. So this one we watch, and what you want to watch for, because we had a pretty sharp uptrend, what you want to see is downside tomorrow to confirm it. If you get a green candle, then it was just noise within the uptrend. That's all. And then we don't even revisit that. So let's see what happens tomorrow. Again, that was the last one. And don't forget, I'll get to QQQ in a second. We had big bearish engulfings on the monthly chart. Those are very rare last month, and so those speak to the longer term outlook. So that's that. That's the Dow. Here's the S&P 500. Big bearish engulfing there as well. Again, you had one right there at the top in May, and so these deserve monitoring. And again, we want to see some downside tomorrow. We've been dancing on support, which I'll get to on the intraday charts here in a minute. So that's that, and you can see on SPY there's the effectively a double top. It's been stalling out around that 294 level so far. and we'll see where we go from here. All right, IWMs are the small caps. This tracks the small cap ETF, bearish engulfing candle as well right there. And in your mid caps, I think we missed it by just a hair. We did, because we closed up 0.07%, almost flat. So we had the chance before the closed. We were engulfing that, but we didn't in the mid caps. And QQQ held up well. I'm going to give QQQ some credit. It closed. It was basically a flat day. Like I said, most of the indexes were either slightly down or slightly up. So you'll give it to QQQ because what I noticed, most of the FANG stocks held up. Apple closed positive, Amazon slightly positive, Alphabet was up most of the day, it closed down, Facebook was up. I want to show you Microsoft also. Microsoft has been the best of the breed in the FANG stocks. Those are the 5 largest components of the NASDAQ 100 and 4 of the 5 largest in the S&P, I believe. So there's also a big old bearish engulfing. So Microsoft, which has been the strongest, only won it, I believe, at all-time highs yesterday. That was, maybe even today might have popped it. Put in a nice big bearish engulfing candle as well, and it didn't just put in a bearish engulfing after a prolonged uptrend. It also did it with a divergent high right here. So we have potential, what I call unconfirmed divergence. So here's the stock I'm going to watch. If Microsoft starts to move down later this week and into next week, it's going to confirm this negative divergence. And this being, should be right now the largest company in the world. Yep, it's the only one in the $1 trillion club at the moment. And I believe, if I'm not mistaken, let me look at something else here on another monitor. Yeah, Apple's a little below and everything else. So we'll watch Microsoft going forward, because that will certainly have an impact on both the S&P 500 and the NASDAQ 100. All right, drill down to the intraday charts. What's going on here? Not too much. Let's not try to make too much of a day that's virtually flat. But what we did is, you recall, we had the bull flags last week on Friday right there. They popped. Started to look impulsive, but that failed. They were met with selling. That foiled the, what it should look like. A bull flag has an impulsive move leading up to the formation of flagpole, and an impulsive move out and all the way up to the pattern target is met. The selling was met. There was some selling there that kind of foiled things. I pointed out yesterday. We popped up again, great, but we couldn't hold those highs. They faded 100% of the rally and then some. And they took out this. There's a minor uptrend line, or an uptrend line to watch on QQQ. That was taken out. And what we're doing is we're dancing on my 183-ish level. And from my experience, anything can happen, because like I said this in the video earlier today for members. Support is support until unless broken. So it was first resistance. When you pop resistance, it then becomes support. And we've had 1, 2, 3, 4, 5, 6. These are all 60-minute candles. Multiple back tests at that level. And it is holding. So you have to give it right now, still to the bulls. But from my experience, the more taps of a level you have, tap, 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 it's eventually going to break. Healthy scenario would have been a back test and then, continued on to the races. Anything can happen. This is consolidation. Maybe this is just the NASDAQ 100 working off the near-term overbought conditions. And if that's the case, then you want to power up above today's high. You want to see it power up above today's high, and then that 186 level. Like I said, that's where I start to change my outlook for the market. It doesn't mean I flipped everything long to bullish, but it's where I begin to start exiting the shorts that I just scaled into over the last several trading sessions there. After closing out longs. So that's QQQ level to watch, and then below that you can see support there. That would be the top of the gap from it was yesterday's gap. Yep. Yeah, and that's about 182.24, and then the flag, of course, or the bottom of the gap as well. And if that goes, that's going to be pretty darn bearish, especially if it goes tomorrow, because it'll firm up those bearish engulfing candles on the other indexes that I showed you. SPY broke down yesterday below this fairly well-defined uptrend line. Broke down, back tested it today at the pop at the open, and they faded it. Oh, and I wanted to go back to QQQ and show you just how hard that fade was of today's pop. Here's the highs in QQQ this morning, and they faded it back below the gap, a 1.4% fade. And when we closed the day, we closed up 0.14%, but we also, that's a fade off the top of 1.15%. Means it's a pretty hefty fade. And today we closed green, so I'm not going to sit there and tell you that that's outright bearish and that's a sell signal or anything else. I'm just telling you that the sellers are stepping out now. Their longs are cashing out. Sellers, the market's starting to be met with some selling, so we'll have to watch this. That's it. Let's call it a little battleground, if you will, right now this week between bulls and bears. Bulls want to see this pop above 185, 186. Bears want to see this. So to be continued on QQQ. IWM, let me see if I have anything special for you there. Breakdown of an uptrend line right there. Dancing around support right now. And let's just wrap this up looking at the futures. All right, ES, S&P 500, E-mini futures. Same story. Recently I've highlighted this uptrend line right here. We recently broke down, back tested it just like SPY, and then came back down. And you can see that's a pretty big level. That was our flag that we had Friday afternoon, and then this mumbo jumbo kind of foiled the whole bull flag thing. At least the symmetry of the pattern happened on Sunday night. Again, at the end of the day, we're right about back testing where that flag gapped up and above. So that's support. That little line here, really everything. I guess that's the point of this video is today's lows. We tested as I showed you on QQQ. So tomorrow we gap down significantly, bearish. Or at any point in the day move down below the recent lows that we've been testing in the last few days, bearish. If we gap up and away, then watch these levels. Let's see if we can continue to extend these divergences. Again, I'll make it very clear. I may start reeling in depending on what I see, and if we go much higher, I'll start reeling in some short interest. But I will not be going long, at least not for a while, because of these divergences. They're only going to extend. Doesn't mean they can't get taken out. But if we get another thrust up, you can see here they're still very much intact, and that's what it would look like. So we had a little divergent high there, a little correction from it, pushed up, extended the divergence, a bigger correction, and we could certainly do that again tomorrow or later this week. So that's what ES looks like. The S&P 500 E-mini futures. This is what NQ looks like. There's an uptrend line right here. You can see it pretty well defined. I'll highlight it there. It's purple. Now what I'm going to do at this point, that's the best fit. It catches a lot of the candles there. Let me zoom in a little tighter for you there. But I'm going to drag it now so we can look at it this way. We can say this is a breakdown and a little consolidation, maybe bear flagging actions. There's your flagpole, bear flagging. If the futures do this overnight, and we open down there, we're going to gap down. We're going to gap down below that level on QQQ that I talked about. This would be your next support right here, right about where that flag broke out. There's a bunch of candles there. And that would also measure for that bear flag target. So that would be our first support. Not the end of the world for the bulls if it happens, but it is starting to firm the bearish case up because we broke this trend line and we're going to move down, and that breakout above those levels in QQQ and SPY recently will have failed. So that's what I'm looking for tomorrow. And if I want to do this, and it's probably the safe bet, I'll call it, this is what I call the BOD, or benefit of the doubt trend line. I'm going to drag this trend line down a little more. Why? Because it captured, I had two little candlestick tails there, little shadows that I had cut off before to capture all these candles here on that first trend line. But now we can come in because we have enough reactions here. We have several reactions back here. We had those two candlesticks there, the little shadows, and now the reactions today. Either way, 6 to 1, half dozen to the other, doesn't matter, because if we break it, we break down tomorrow. If we break that 74.81 support, we'll break this trend line. Or if I put it back the way I had it and say that the trend line was already broken, then we're just back testing and consolidating with flag type action. And if we go down, we break below the flag. So for the bears, it's win-win if we break down at least very near term. And what I've been telling members today on the site in the trading room is, look, I'm liking what I'm seeing so far, but nothing to get excited about because there's still a lot of support on the way down. When you come up through an uptrend like this, after a downtrend, you have a lot of support levels to trade. It gets trickier when the market's trading at all-time highs. You don't have a lot of support levels to go long on pullbacks. But what I'll be watching for is the nature, how those pullbacks are treated. Today we shot down below the gaps on SPY and QQQ. Remember, we gapped up. Here, I'll show you on a 1-minute chart. Let's go to QQQ. We gapped up, and so in trading, you have a couple levels here. You have the top of the gap would be your first support level right there, and it's also right around that reaction high. That often gets bought back up. It didn't. It came into the gap then. They entered the gap right here and backfilled it. Now this was the bottom of our gap where we closed. That yellow line shows yesterday's close. Well, we went on right on through there. We happened to overshoot it. It turned out to be a momentum overshoot. We just slightly overshot it and then regained it and then danced on it. So we're not out of the woods yet, but it's not a breakdown either. What I wanted to get to here, what I was talking about on the futures, go back to NQ, is how if we move lower, if we just head on up, burn through all these divergences, regain that trend line, keep on going, then none of this matters. I'm telling you where I think it's going to happen, and if the other thing happens, I'm just wrong, and I'll get out of the shorts right now and look to get into them later. So I'm not going to spend time talking about if we go up, other than a break above. Anytime you have an uptrend, each time you take out the previous reaction high, that's on face value, that's bullish. I don't chase it when the divergences are there and other red flags and things like that, but that's that. What I wanted to say is how we act if we move down tomorrow. Let's say we break from this below this bear flag pattern and we come down, hit that measured target, which coincidentally or not comes right around that 74, 30, 31-ish support. How do we act there? That's the measured target. Do the bulls step in and buy and rally it back up? That would be, what they should be doing, what I'd be doing if I was bullish and thought the market was going to new highs. I'd be looking to buy pullbacks to support. If they smash on through it like it's not even there, or let's say, for example, you get a very muted reaction. We hit it, markets bounce a little bit, then go back down. Here's the next support right here. How do we act there? If we smash on through these levels like they're not even there, then that may be a sign, an indication that this is the start of something more. And again, I'll wrap it up here. I covered this the other day. Just to have your ducks in a row. Again, market's going to do what it wants to do. I'll tell you what I think it might do, and that's all. It's going to be right or wrong. But if it does what I think it does, if this is a bear market rally, or even, let's not even use that word. I know a lot of people get upset and trying to say we're in a bear market. All right, so let's just say that this is just a counter trend rally like these two. Remember, if you watched yesterday's video, this rally fell shy or maybe about equaled these previous two right here. But if that's all it is, the counter trend rally in a much larger drop with more downside to come, which it very well could be, then remember this, and I showed this yesterday, we dropped very quickly here. These drops down here happened in just, let me get rid of that tool and go back here, get rid of that, and tell you how fast we dropped. That was, once that counter trend rally was over, the market fell 10.5% in just 9 trading sessions. After this very impressive counter trend rally, which again was equal or greater than the one we just had, the market fell over the next 13 trading sessions. It was 3 weeks, roughly 3 weeks, or 14 trading sessions. It's showing in the pop-up box, about 17%. So when the point being, this is either a counter trend rally with another move coming, and if it is, we're probably going to go down pretty quick. So therefore, you should have your ducks in a row. What does that mean? If you're long, where are you going to stop out if we start going down? And if you are short, looking to get shorter, or not, you're just in cash looking to add shorts, you got to be ready to go. You got to be ready to pull the trigger, because if you wait just a few days, you're missing an objective entry. The half the move may be over, or most of it. So that's why I do these in advance, to kind of give you the levels and set the expectations of what could happen. And now, if this is just the start, if this whole rally here is a start of the road to new highs and beyond, then I'm giving you levels, and I've been giving you out on SPY, QQQ, the futures, levels that quote unquote should contain a pullback where buyers should step in. Those are levels where I'd be stepping in if I was bullish and looking to position or add to positions to new highs. So that's what I'll be looking for. How are those levels treated. What happens when the market hits those support levels? If it just keeps smashing through like they're not even there, or you get little fleeting bounces and then more sellers come in, then that it's going to be indicative of the fact that the supply demand right now is favoring the sellers. There's more sellers in the market, more longs that want out, more shorts that want in, and just not enough buyers on the sidelines waiting to step in and buy the dips. All right, so we'll wrap it up here and pick this up tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.